Welcome to Finance Frontier. High-yield savings accounts versus CDs in 2026 is not really a debate about which one is safer. Both can be federally insured. The real question is much simpler and much more important. How fast do you need your money? If you want cash, you can reach quickly. A high-yield savings account may fit. If you want to lock in a rate for a set period, a CD may make more sense. And if you've ever wondered where your emergency fund, short-term savings, or next big goal should live, this comparison can save you from a costly mistake. Let's start with the basics. A high-yield savings account, or HYSA, is a savings account designed to pay more interest than a traditional account. The key word is access. You can usually move money in and out when you need it, which makes it useful for emergency funds, job transition buffers, or money set aside for near-term surprises. The APY is variable, so it can move with market conditions, but the trade-off is flexibility. A certificate of deposit, or CD, works differently. With a CD, you agree to leave your money untouched for a specific term, such as 6 months, 1 year, or longer. In return, the bank offers a fixed rate for that period. That certainty can be appealing, especially when rates are falling and you want to lock in today's return. So here's the core tension. A HYSA gives you freedom. A CD gives you commitment. Neither one is automatically better. Now let's talk about rates, because this is where many savers start. As of the FDIC's May 18, 2026 national rate update, the national average savings rate was just 0.38% APY. That means money sitting in a typical account may be earning almost nothing. By contrast, competitive online HYSAs often pay multiple percentage points more. In other words, shopping around can matter a lot. CDs tell a similar story. In that same FDIC update, the national average 12-month CD rate was 1.5% APY. But many top one-year CDs listed in June 2026 are around the 4% range. That gap is a reminder that averages are not the ceiling. If you compare options carefully, you can often do much better than the national norm. That said, rate is only one part of the decision. Liquidity is where the differences really show up. With a high-yield savings account, access is the advantage. You can usually transfer money when you need it, though the exact rules depend on the bank. The old federal limit of 6 convenient withdrawals per month was removed from Regulation D back in 2020. But many banks still set their own transfer or withdrawal limits in the account agreement. So while HYSAs are built for access, you still need to read the fine print. With a CD, the money is intentionally locked up. If you cash out before maturity, you typically pay an early withdrawal penalty. Federal law sets a minimum penalty, but there is no maximum, which means the exact cost can vary by institution. That penalty can take a real bite out of your earnings, especially if life changes and you need the cash sooner than expected. And that is the biggest mistake people make with CDs. They lock the money, and then life happens. A car repair hits. A move comes earlier than planned. A medical bill shows up. Suddenly, the rate that looked great on paper matters a lot less than the penalty you have to pay to get your own money back. That's why the right choice depends on your time horizon. If the money might be needed soon, a HYSA usually makes more sense. If the money has a clear purpose and a clear date, a CD may be the better tool. Think of it this way. An emergency fund belongs in a high-yield savings account because emergencies are unpredictable. Money for a wedding next summer, tuition due in a year, or a planned move with a known date could fit well in a CD because the timing is more certain. You are matching the account to the job. Now let's cover safety, because many people worry that higher yield means higher risk. In this category, the answer is reassuring. Both HYSAs and CDs at FDIC-insured banks are protected up to the standard insurance amount of $250,000 per depositor per insured bank for each account ownership category. That coverage applies to savings accounts and time deposits like CDs. It includes principal and any accrued interest through the date a bank closes. But here is an important detail many people miss. FDIC insurance is not $250,000 per account. It is $250,000 per depositor, per bank, per ownership category. So if you split money into multiple savings accounts and CDs at the same bank, that does not automatically increase your protection. The coverage is based on the total in that ownership category at that bank. If you use a credit union instead of a bank, the parallel protection is NCUA share insurance, which generally works in a very similar way for depositors. So on the safety question, the answer is simple. Both can be safe. The real difference is access versus commitment. Minimum deposits can also affect your choice, especially if you are just getting started. Many high-yield savings accounts advertise a $0 minimum opening deposit, which makes them easy to start with. Some competitive HYSAs do require a minimum, often around $100 or $1,000, but many still remain beginner-friendly. CDs, on the other hand, often require more upfront cash. Minimums of $500 to $1,000 are common, and some are higher. That can make HYSAs the easier entry point for new savers, while CDs may suit people who already have a lump sum set aside. There is one more factor worth mentioning in 2026. Rate direction. Several rate tracking summaries show CD rates drifting after late 2025 Federal Reserve cuts. In an environment like that, CDs can be attractive because they let you lock today's rate for the full term. A HYSA, by comparison, can move up or down as the bank adjusts its pricing. That means the best choice depends not just on today's rate, but on what you think rates may do next. If you expect to need flexibility, a HYSA wins. If you want certainty, a CD wins. And if you want a little of both, there is a middle path. A CD ladder lets you split money across multiple CDs with different maturity dates, so something comes due regularly. That way, you are not locking all of your cash away at once. You keep some access while still taking advantage of fixed rates. It is a practical compromise for savers who want structure without giving up liquidity entirely. So let's bring it all together. Choose a high-yield savings account if you want easy access, a flexible emergency fund, or money for short-term uncertainty. Choose a CD if you have cash you will not need for a defined period and you want to lock in a rate with more certainty. And if your savings goal sits somewhere in the middle, consider combining both. Use the HYSA for flexibility. Use the CD for commitment. That simple rule can remove a lot of confusion. At Finance Frontier, the goal is not just to chase yield, it is to match your money to your life. When you do that, your savings work harder and you stay in control. Start with your time horizon, then compare APY, fees, and penalties. For more smart money guides, subscribe to Finance Frontier.